So welcome back. We are going to start with a very important topic, that is put call ratio as the technical indicators. So I hope you have understood the previous two lessons very well because they are the foundation for this lesson. And secondly, I would like to tell you that this lesson is likely to become quite long. I would rather finish it off in one go, but if it becomes too long, then I may break it into two parts. But I hope you are in a fresh mind so that you can understand it better. A slightly complicated subject. So if you have understood the previous two lessons, we shall now talk about the put call ratio. What is it? It is just the put option trades divided by the call option trades. Now it could be based on volume, that is the volume of put trades divided by the volume of call trades in a given period of time, or it could be based on open interest. That means the open interest in put trades divided by the open interest in call trades at that moment of time. Slightly complicated. Normally we would go by open interest based put call ratio. I'll explain to you why is that. Okay. Now you'll ask me what is the difference between volume and open interest. Quite simple. Volume of trade means how much trade has happened over that given period of time. And open interest means actually how much trade is open at that moment of time. Don't worry, it is not that difficult. I'll just explain to you with an example. Hypothetically, consider yourself and me. Okay, on one hand it is you, on the other hand it is me. Let us say at 0930 hours in the morning, you buy one lot of option from me and I sell you that one lot of option. One trade has happened. At 1000 hours, you sell it back to me, I buy it back from you. Okay. At 10:30 hours, you buy it again from me, I sell it to you. Alright. Then at 1100 hours, again you sell it to me and I buy it from you. So in terms of volume, 4 trades have happened. Okay. 1, 2, 3, 4. 4 times the option lot has exchanged hands. 4 trades have happened. But in reality, finally only one trade is open, this last one, where you are the seller and I am the buyer. Alright. So open interest, the number of open trades at this point of time is only one. All these three have been extinguished. They are closed. Got the point? Though the volume is 4, the number of trades which are actually open at this moment of time is only 1. So therefore, volume can be very deceptive, can be very manipulative. I strongly recommend that you consider open interest based put call ratio. But the choice is yours. You can refer to either of them, whichever suits you. Alright? So now in short, what it means is that put call ratio is the open interest in put option trades divided by open interest in call option trades. I have explained to you what open interest means. Alright. Now you don't have to calculate. You just have to go to whichever website you are trading on. Normally all the websites which offer trades, they will give you the put call ratio for the various indices also and for the various stocks also. You will easily find it there. Different people in different countries may use different sites. And one such site which I use is this capitalmarket.com. Quite a simple one. So you just go to the site and here you can see down. You can select whichever stock you want to see, the put call ratio of whichever stock or the index, whatever you want to see, you can select from that. Then you can also select the expiry date. You want to see the put call ratio for which expiry. Alright, you can check from here. Then you can also select whether you want to see the put call ratio based on volume or whether you want to check it based on the open interest. Here I have selected both. So you can see I'm getting the open interest for both. This is for the volume and this is for open interest. Now since I have not selected any symbol, it is showing me everything starting from the alphabet A. He will show me everything now. So let us see for this Aarti Industries, whatever it is. Here you see for the expiry of 27th April, these are the number of put trades, these are the number of call trades, and this is the put call ratio 0.32. Now this is based on volume. If you want to see based on open interest, it is this much here 0.64. 0.32 and 0.64, quite a vast difference, isn't it? So therefore you have to decide your threshold based on what you are looking at, whether you are looking at the volume based PCR or looking at the open interest base. I would recommend open interest base, but just in you are looking at it volume, that also is okay. But it should not happen that sometime you are looking at volume, sometime you are looking at open interest. It should not happen like that. Alright. So you know now where to see the put call ratio. And just in case if you are in India, then this is another site, optiontools.in. Here also you can, for the Nifty and for the Bank Nifty, you can see the put call ratio. If I click on Nifty here, okay, let me just, okay. Alright. So this is the PCR for the Nifty. The green line is the PCR value and the black one is the price. So if I see here at this particular moment, the put call ratio, you can see that it is 0.86. I'm putting my cursor here. You see on the left hand of the screen, the left hand side of the screen. At this moment, the PCR for the Bank Nifty is 0.86 and the price is given here 17013. All right. Now, if you want to see for the Bank Nifty, then just click on this. Okay, now you have got it here for the Bank Nifty. Okay, for the Bank Nifty at this particular moment, you see here on the left hand side, you see it is 1.12. The PCR is 1.12 and the price of the Bank Nifty is 40022. Got it? So now we have seen that you can check the put call ratio of any individual stock, and you can also check the put call ratio of various indices like the Nifty, Nasdaq, Dow Jones, or maybe Singapore Nifty, whatever. In whichever country you are, your own indices, you can check the put call ratio. Alright? And sometime you will find that the put call ratio is a figure 1. Now what does that mean? That means the open interest in put option trades and call option trades are equal. Therefore, the ratio is 1. It is a balanced market. But sometime you may find that the put call ratio is less than 1. What does it mean and why is it so? It so happens that the call option open interest is more here. You see, this call option trades are more, put option less. So obviously just a simple mathematical thing. The ratio will be less than 1. It will be 0.9, 0.95, 0.8, whatever. Alright. And sometime you may find that the PCR is more than 1. What does it mean and how does it happen? Simple again, simple mathematics. When the open interest in put option trade is more than what it is in the call option trade, the ratio will be more than 1. Simple mathematics, isn't it? So now we come to the point. Alright. Let us say that the put call ratio of Nifty, one of the indices in India, let us say the put call ratio of Nifty is 0.9. Alright. What does it mean? Put less, calls more. It means that the open interest in call option trade is more. Alright. That is what it means by this ratio being less than 1. Now at this juncture, what do call option sellers want? And when we are talking of the call option sellers, we are not talking of the small traders. You remember, we want to follow the big sharks. So we are talking about the big sharks. What do the big sharks want now at this moment? They want the Nifty to go up. The option sellers, the big time option sellers, they actually want the Nifty to go up. If the Nifty goes up, their portfolio will gain, though this option will lose. But they are not worried about losing on the option because they are primarily hedging. Got the point? We have discussed this already. So they want, the big players want the Nifty to go up. But just in case the Nifty goes down, then what? Then the sharks will do more hedging. They have done hedging by shorting the call options. Now if the Nifty goes down, they will do more hedging by selling more call options, because the previous short positions in the call options is in the profit. So what do we understand finally? Let us draw some logical conclusions. Alright. Number one, we have seen that if PCR is less than 1, if the put call ratio is less than 1, that means that the call option trades are more than the put option trades. Obviously, the ratio will be less than 1 only if the denominator is higher than the numerator, isn't it? Number two, you must remember that if the call option trades are happening, then there have to be the buyers of the call options and also the sellers of the call options, isn't it? Then only the trade will happen. So who is buying the call options? Call option buying is done by small traders like you and me, who expect the price to go up. In the expectation of the price going up, small traders are buying the call options. Alright? And who is selling the call options? We have discussed that. We have seen the big sharks, the big investors are the sellers of the call option. They are also selling call option in the expectation of the price going up. They are selling it as a matter of hedging. They are also expecting the price to go up. But unlike the small traders, they are not buying the call options. They are rather selling the call options. Why? As a matter of hedging. They are afraid, though they know their analysis tells them that the market is going to go up, but they are afraid that just in case it does not go up, then what? So they are hedging themselves. Got the point? The difference between these two views? Alright. So if the PCR is less than 1, then we should expect that the market will go up. Both these people are thinking that the market will go up, isn't it? So if the PCR is less than 1, our logical conclusion is that the market is very likely to go up. Keep that in mind. Why? Not because the small traders are thinking that. Of course, the small traders are also expecting the market to go up, but we are not following the small traders. We are following the big sharks. Because the big sharks are thinking that the market will go up, we also believe that the market will go up. Understood? Alright. Now what? Now just in case the market does not go up. Of course, everybody is thinking that the market will go up, but the market is not duty bound to obey us. Just in case it does not go up, then what happens? Then four things will happen. Number one, the portfolio of the big sharks will suffer. Remember, the big sharks have actually hedged their portfolio. They have a lot of things in their portfolio. We have seen that 5,000 Tesla, they want the price to go up. If it is not going up, then of course their portfolio will suffer, isn't it? But on the other hand, the big sharks will be gaining by retaining the premium they have taken by selling the call options. So their portfolio is suffering, but their option trade is gaining. Alright. So what the big sharks will do? The big sharks will do more hedging by selling more options. If the price comes down, if the market keeps going down, they will do more hedging by selling more options. And if the market keeps coming down, they are not expecting the market to come down, but just in case, against their expectation, if the market keeps coming down, they will do more and more hedging. So what will happen as a result of more and more hedging? As a result of selling more and more call options, the denominator in the PCR will keep increasing and the PCR will keep coming down, isn't it? The ratio, the fraction will keep coming down from 0.98, it will become 0.8, 0.7, 0.6, maybe 0.5. Alright, so as the denominator keeps swelling, this PCR will keep coming down. then what happens? How long or how far then the PCR can come down? At some stage, the big sharks will say enough is enough. We are fed up now. They will say the market has gone down enough. We cannot afford to let the market go down further. So they will turn back and they will attack. What will they do now? At some stage, they will start squaring up their option positions. If this is the PCR scale, just for your understanding, at some stage, the PCR keeps coming down unexpectedly, but at some stage, the market is said to be oversold. Buying will now start. How the buying will start, I'll explain to you maybe in the next part. But try and understand that once the market gets oversold by this becoming very less PCR, what the big sharks will do is they will start squaring up their short positions in call options. They have taken a lot of premium by shorting the call options. All that premium they will retain. They will start closing their positions. They will start reaping the profit. But on the other hand, their portfolio holding is in a loss. The portfolio is going down while they are booking profits in the option trades. Now in the next part, we shall see what the sharks are going to do with their profit in option and how the market will pull back from here. The market has gone down enough. The sharks have turned back and are attacking now. We will discuss how their attack works and how the market will pull back. All right.